Most people think the hardest part of investing is making the first move. It's not. The hardest part is what comes after. Because the moment you put real money into the market, something changes. It's not just a concept anymore. It's your rent money, your car payment, your future sitting in a number that moves every single day. And that number is going to go down. Maybe not today. Maybe not this week. But it will go down. And when it does, the decisions you make in that moment will determine whether you build wealth or whether you quietly undo everything you just started. 4 mistakes: checking obsessively, panic selling, timing the market, concentrating in one stock. Most people make at least one of them in the first year. This video makes sure you're not one of them. This video is about those decisions. The 4 mistakes most new investors make right after their first investment. And the framework that keeps you from making them. Mistake number 1. And it's the one nobody talks about because it doesn't feel like a mistake. It feels like being responsible. Checking your portfolio every single day. Here's what actually happens when you do that. You open the app Monday morning, up 2%. Feels good. Tuesday, flat. Wednesday, down 3%. Your stomach drops. You start reading articles about why the market is falling. You find 3 different opinions. 2 of them say sell. 1 says hold. You don't know who to believe, so you do nothing, but you feel anxious all day. Thursday, up 1.5%. You exhale. Friday, down again. You haven't made a single trade, but you've spent an entire week on an emotional roller coaster that has absolutely no bearing on where your investment will be in 10 years. Think of it like checking the weather every hour when you've already planned a camping trip 3 weeks from now. It doesn't change the trip. It doesn't give you useful information. It just fills your head with noise that makes you feel like you should be doing something, when the right move is to leave it alone. Berkeley professor Terry Odean studied tens of thousands of retail investors and found a direct relationship between trading frequency and returns. The highest traders had the worst results. Those who barely touched their accounts came closest to capturing full market returns. The data is clear. Inactivity beats activity in investing almost every time. Set a schedule. Check once a month, maybe once a quarter. Then close the app and go live your life. But here's the thing, even people who stop checking every day still make the next mistake. And this one costs a lot more. Mistake number 2. And this one destroys more wealth than any bad investment ever could. Panic selling at the first drop. Here's how it plays out. You put $1,000 into an index fund. 2 months later, the market drops 12%. Your $1,000 is now $880. You feel sick. Every headline you read confirms that things are about to get worse. Your brain starts doing the math on how much you could lose if it drops another 20%. So you sell. You lock in the loss. You tell yourself you'll get back in when things stabilize. Things stabilize. You wait. They go back up. You wait a little longer, because now you're afraid to get back in at the wrong time. The market hits a new high. You miss the recovery. Your $880 in cash is still $880 while the index fund is back at $1,150. This is exactly what the data shows happens to most retail investors. They sell low and buy high, the exact opposite of what works. Think of it like leaving a cookout the moment it starts drizzling. The grill is hot. The food is almost ready. But the first sign of rain sends you inside. And by the time you come back out, everyone else has already eaten. The storm passed in 20 minutes. You missed the whole thing. The S&P 500 has recovered from every single bear market in its history and gone on to set new highs. Every single one. The drop isn't the problem. Leaving during the drop is. When your portfolio falls, do nothing. That's the move. Not confidence, not research, not a better strategy. Just nothing. Avoiding panic selling doesn't mean you're safe though. Because the next mistake feels completely different. It feels like you're being smart. Mistake number 3. And this one is seductive, because it feels like intelligence. Trying to time the market. Here's what market timing looks like in practice. You think the market is overvalued. You pull your money out and wait for a correction. The market goes up another 15% before it dips. You get back in, now at a higher price than when you left. Or you see a headline about a recession coming. You sell. The recession never arrives. The market climbs. You buy back in at the top because you've been waiting long enough. Every version of this story ends the same way. You pay more, earn less, and take on more stress than if you had simply stayed in. Think of it like a fantasy football manager who benches his star quarterback every time the matchup looks tough, swapping him out for a backup based on the weekly projections. Projections are educated guesses. The starter almost always outperforms the backup over a full season. The manager who trusts his best player consistently beats the one who overthinks every decision. JP Morgan Asset Management tracked a 20-year period and found that if you missed just the 10 best days in the S&P 500, your overall return was cut in half. 10 days, out of more than 5,000 trading days. Let that land. And those 10 days almost always happen during the most volatile periods, when most people are sitting on the sidelines waiting for things to calm down. The market rewards patience. It punishes timing. Stop trying to predict it. Stay in. Stay consistent. Let time do what timing never can. And if you've made it past the first 3, most people haven't. There's still one left. And it's the one that looks most like a good decision. Mistake number 4. And this one feels like conviction, but it's concentration risk with a confident face. Putting everything into one stock. Here's how this one starts. You do some research. You find a company you believe in. Maybe it's a tech stock you use every day. Maybe it's a brand you trust. Maybe someone you respect mentioned it. You feel good about it. So you put your entire first investment, $500, $1 million, $2,000, into that one company. And maybe it works for a while. Maybe it goes up 20%, and you feel like a genius. The problem is that single companies can lose 50, 60, 70% of their value and never recover. It happens to household names. It happened to Enron, to Blockbuster, to companies that seemed untouchable right up until they weren't. Think of it like patching a hole in a wall with every tool you own, all your time, all your materials, all your effort, on that one spot. Then a pipe bursts somewhere else. You've got nothing left. No tools, no materials, no backup. The whole house is exposed because you put everything into one fix. An index fund is the opposite. You spread your resources across every wall in the house. One spot cracks, the rest hold. You don't need to predict which wall is going to hold best. You own all of them. This is why index funds are the first recommendation for beginner investors, not because they're exciting, but because they remove single company risk entirely. Your first investment doesn't need to be a bet. It needs to be a foundation. Diversification isn't settling. It's strategy. 4 mistakes. Same root cause. Impatience. The belief that more action equals more control. It doesn't. In investing, less action almost always means better outcomes. Your job after your first investment isn't to manage it. It's to protect it from yourself. From the urge to do something. From the anxiety that comes with watching a number move. From every headline that tells you this time is different. It's never different. Stay in. Stay consistent. Let the tree grow. So what do you actually do after your first investment? 3 rules. Simple enough to remember. Strong enough to keep you out of every trap we just covered. Rule 1. Set it and schedule it. Pick a date to review your portfolio. Once a month. Once a quarter. Put it in your calendar like a dentist appointment. On that date, and only on that date, you look. You assess. You decide if anything needs to change. The rest of the time, the app stays closed. This removes the daily noise and puts you back in control of when you engage, instead of letting the market drag you in every time something moves. Rule 2. Write down your why before the market drops. Before the next correction hits, and it will write down in one sentence why you invested in the first place. Your goal, your timeline, your reason. Something like, I'm investing for 20 years because I want financial freedom at 50. When the market drops 15% and every headline is screaming, pull that sentence out, read it, then ask yourself, has anything changed about that goal? Almost always, the answer is no. The market moved. Your reason didn't. Rule 3, automate everything you can. Set up automatic monthly contributions. Same amount, same date, every month. Think of it like a running back who hits the hole the same way every play. No hesitation, no overthinking, no reading the defense before committing. He runs the play. Every time. Consistent execution beats winging it in football and in investing. 3 rules. Write them down somewhere you'll see them the next time the market scares you. Before I let you go, 4 quick signals that tell you the strategy is working, even when it doesn't feel like it. Think of it like water slowly filling a reservoir. You can't see the level rising hour by hour. Standing at the edge, it looks the same as yesterday. Same as last week. But the water is coming in, steady, consistent, every day. Then one morning you look out, and the reservoir is full. The work was always happening. You just couldn't see it from where you were standing. That's compounding. So here's your checklist. 1. You're still invested. You didn't sell during the last dip. That alone puts you ahead of most retail investors. 2. Your contributions are automatic. Money is going in on schedule without you having to decide each month. 3. Your portfolio is diversified. You're not concentrated in one stock riding on a single bet. 4. Your time horizon hasn't changed. You're still investing for the same goal you started with, not reacting to last week's headlines. If all 4 of those are true, you're not just on track. You're ahead of the curve. Most people never make it past the first year without breaking at least one of them. The strategy is working. Give it time to prove it. Your first investment is the most dangerous one, not because of the market, but because of what the market does to you. It tests your patience before compounding has had a chance to reward it. It drops before you've built the discipline to hold. It moves in ways that feel personal, even though it knows nothing about you. The 4 mistakes in this video aren't rare. They're the default. Most people make at least one of them in the first year. The ones who don't are the ones who had a framework before the emotion hit. Now you have one. Drop a comment and tell me which of these 4 mistakes have you already made or almost made. Number 1, 2, 3, or 4. I read every comment and I'll reply to as many as I can. And if you know someone who just made their first investment, send this their way. Go make your money work. I'll see you in the next one.